Yep, Philip Lowe simply can't stop, won't stop pulling that darn lever. The RBA boss piling on the pain with an 8th straight rate rise. Today's 0.25% hike means monthly repayments on an average loan have risen by $834 since April. That's a whopping $10,000 a year.
These interest rate rises are already having harsh and heavy consequences on a lot of household budgets and on a lot of mortgage repayments. We expect that the full impact of these rate rises will be felt down the track.
Borrowers on historically low fixed rates have been spared so far, but with 2/3 of all fixed loans expiring next year, a mortgage cliff is looming.
So those who are on fixed loans who have yet to feel how bad this is, they're not getting gradual increases. They are getting it all in one foul whammy. So this is going to hit a lot of households really hard when they roll off those fixed rate mortgages.
And with property prices falling faster than a hapless coyote, 2023 could be a bloodbath.
The people that I worry about the most are those first home buyers, young home buyers who've come in the last 2 years at the peak of the market with really high prices. They face the potential not only of interest rate rises and possibly some more next year, but lower house prices, and there's a risk that the labour market is going to weaken. There are some people that are going to feel excruciating pain in 2023.
While it might seem a little sadistic, it's not about making millennial mortgagees miserable. They're just collateral damage in the effort to slay the inflation dragon.
Our economic plan is about making the budget more responsible, the economy more resilient, and fighting inflation as our number one priority in economic policy.
The good news, the RBA won't meet again until February, giving them a chance to assess the fallout from their rate rise rampage. So could the carnage finally be over for borrowers?
Let's see. Glenn James is a financial planner with a podcasting side hustle. He joins us now. Glenn, just how many people will this push to the brink?
Well, I think it's important to step back and actually get some perspective. 3.1% interest rates, we know that the average from 1990 to 2000 was 6%, and the 2010s is looking like about a 3% average. So I don't know if it's as bad as it might seem.
Glenn, this was meant to be the freedom Christmas. After the fires, the lockdowns, the lockdowns again, how's this going to affect spending and confidence?
I talk with a lot of millennials. I asked a lot of millennials in our My Millennial Money Facebook group just last night what their sentiment was. 88% of people actually said they're not too worried, or they'll just have to tighten their belt a little bit. I think a lot of people are now starting to think about, well, hey, we're not buying adults gifts. We'll buy the kids gifts, or we'll have a secret Santa. Or I've been telling people to start controlling the narrative now. Get the group message and tell people, hey, we're not doing presents this year. We're just doing nice words and, massage vouchers for your special someone.
The other thing we should bear in mind is there are a bunch of people who have felt nothing as a result of these rates going up because they're on fixed rates and have been for a while, but they are about to get a shock. Like, they are really about to hit that cliff. Is there anything they can do now before they get to that point that will help them when they get there?
Yeah, I think the only solace in this is knowing that we are being warned. It's not as if they're waking up tomorrow with an extra $200, $300, $500 mortgage payment. I think it's about being active, being proactive, calling your bank now, calling your mortgage broker now, and getting in front of the curve. But I just want to do a bit of a shout out for, there's a lot of people who do not have a mortgage and that they rent, or particularly retirees. This is manna from heaven for them, this news, right? People can actually start getting some interest, which they haven't really had decent interest return on their money for some time.
That is true and worth remembering, but renters surely are in just as much pain, right? Because their landlords are paying mortgages, and if their mortgages go up, they'll pass that on, and we're seeing rents just take off.
Yeah, it's actually wild out there, and what I suggest to listeners of the podcast is that, if you are receiving a rent increase, most state-based laws actually say that you can ask for some evidence of how they've calculated the rental increase. You can't just pass on a rate increase. That has to be reflected in the market. So just for those renting out there, you can always politely push back and say, hey, how did you come up with this $150 a week rent increase?
Glenn James, thank you so much for the insight. Thank you.
Thanks, guys.